specific ones. They're on the webpage. But let's look at the data to see how a farm's been doing over time. So these are we're going to start with some older stuff, and we'll do some dairy stuff, and then we'll come back and do some newer stuff. But here's the UW Center for Dairy Profitability. They've got a couple of web pages here. There's two methods: assets at cost basis with tax depreciation, assets at market basis with economic depreciation. Notice there's no cost for unpaid labor management, no opportunity cost for owner equity. So here's back in the early 2000s, 2000, 2001, 2002. Returns on assets using a cost basis and tax depreciation. You can see it was 7.9, 10, 4% from 2000, 2001, 2002. It jumped around a lot. Return on equity was negative in 2002, but quite large in 2001 and 2000. Profit margin, very small in using these cost basis and tax depreciation, 5% to 12.4%. You go to market value and economic depreciation, the numbers shift. And that's, again, you're capturing some of that. You can see the difference empirically with this cost versus market basis, and then how you do depreciation. But you can see the rates of return on assets are 2 to 5.5%. Return on equity is 0 to almost 5%. Profit margin still really low, 5.8 to 13.3%. So, but you also see the variation from year to year. Now let's look at this from 95 all the way to 2009. This is all the farms in this AGFA database, Agricultural Farm Financial Advisor. It's a database from a bunch of farms. I think there's about 400 or 500 farms in the data set. And so you can see across years, what was the return on assets? Well, you can see 5.6, 5.4, 5.4, 9.2, 7.6, 4, 5.5, 5.62. Then you can see up and down, up and down. But there's generally a positive. 2009 was actually negative. It was a bad year. So you take a year that looks on the lower end. 2002, what's the average? It's 2.2%, 2.17. But now go into that, instead of looking at the average of the whole population of farms, let's look at the distribution of that sum to get a sense of how much variation there is around that average among these farmers. What you can see is, okay, the average is 2.17%. 35.5% of the farms are actually negative in the data set. And then 0 to 2.5% rates of return, another 20%. And so you can see 55% of the farms were below 2.5%. So 2%, 2.17% is not a great average, but some people did really badly compared to that. And then you can see even that relatively low income year, the low return on assets year, there are still 7% of the farms had over 10%. Another 7% were in that 7.5 to 10% rate of return on assets. And so even in this bad year of 2.2% as an average return on assets for the whole rate of return on assets for the whole industry in the state, almost 15% of the farms had a large return on assets that year relative to their peers. And so my point I'm trying to make is even this number here, minus 1.65%, there's most likely going to be a certain number of farms that actually still made a good rate of return that year. Same point being made here. This is 2009. This was 2002 for the 2.2%. Here's 2009, which was that bad year. You can see there's a lot of farms that were in that lower end, but there's, on the cumulative side, there's still a decent number that had over 10%, even in that year when there was a bad year. The top 40% had a net farm income of $77,000, whereas everyone else, the bottom 60%, had a net farm income of minus $24,000 almost. Rate of return on assets for that top 40% was 3.3%. What was the rate of return for that bottom 60%? Negative 7.8% rate, and then you can see the returns on equity, the same point. Even in this really bad year with a negative average return on assets, there were still a substantial number of farms that did quite well. Well above they had a low year for themselves. Average is only 3.3% for that top performers, but in that really bad year, they still did well. And the point I'm trying to make is, even in bad years, some farmers are making money. That's the way to think of it. Looking at some more recent Wisconsin data, this is from 2014, 15, and 16. This is during the time when it was pretty tight out there, or started to be, moving into this really rough dairy market we've been seeing. Larger farms have higher rates of return on assets. You go down the column there in the green table, less than 50, 50 to 100, 100 to 200, 200 to 400, 500, 5 to 1,000, and over 1,000. looking at those rates of return on assets, you can see as the farms get larger, there's a higher and higher rate of return on assets. And that's to be expected. They're focused more on efficiency. The average during this time is somewhere in that time period is roughly 120, 130 cows, maybe a little bit more, 140, 50. Today's average is about almost 100, almost 200, not quite. And so that's so the average herd size is sort of in the middle of that table. But you can see return on assets goes up as the herds get larger. But look at the debt to asset ratio. Those larger operations are much more leveraged. And so even though they're making more money in terms of the business, they're not keeping as much of it. A big chunk of it is being sent off to whoever the external equity providers are. And see the profit margins as well go up as you get larger. Starts at a small 3.5% all the way up to 13.3%. So the write-up doesn't explain what they're doing about which asset valuation method, how they dealt with depreciation, non-cash costs, and then any unpaid labor management. I'm not sure how those were dealt with in there. Here's the distribution. We got the top 10, top 25, the middle, and then the bottom 25 and 10%. So we're looking at the distribution by herd size. So, okay, it's been some rough years. I'm going to go back. Well, here, the median's right here. So take an average herd size, 1 to 200 cows, 2.4% is the median, pretty close, sense of the average. The top 10% had a return on assets of almost 10%, whereas the bottom 10% had a loss of minus 8%, or I'm sorry, minus 2%. And so you can see 2.5%. And so you can see, again, even in good years, some farmers are losing money. We saw that. And even in bad years, some farmers are making money. That's the point I really want to make is you will see data on these average returns on assets or rates of return on assets. And the point to note is there's a lot of variation among farmers. And even in good years, some farmers are losing money. And even in bad years, some farmers are making money. What separates them out is hopefully you're on the group that's making money every year or most years. And so on average, you're above average, which, that's hard to do every year on year. But there are good managers out there, and they do make good money, even in tough markets. Switching over to different states here and different crops or different commodities. Here's Iowa. This is for the 90s, 1990 to 1998. And then there's another set for the same for 2000 to 2006. But it's looking at different types of farms. You can see the grain, hog, beef, fed beef. So this would be people buying feeder cattle and feeding them out. And then the cow-calf operation and dairy. You can see there's a variation across these groups. The lower end is the cow-calf operation at 4.5%. It was an average rate return over those 9 years. The upper end was the dairy at 7.6%. Returns on equity, comparable, and then each of profit margins. And notice how these profit margins are much higher than what we saw in those Wisconsin data. My guess part of it is different ways of dealing with is a market or cost basis balance sheet used, and then particularly the non-cash costs and how they're dealing with depreciation. Those are the two big ones, I'm guessing. The non-cash things like depreciation and unpaid labor management. This is now the 2000-2006 data, those 7 years. They're looking at breaking it out by upper, middle, and lower groups on the top 20%. You can see over that period of time, the top 20% had a nice return on assets of 12%, return on equity of 15%. That's pretty good. Current ratios, lots of cash. Debt to asset ratios are fairly constant across this whole group. So all these farms are all about 35 to 45% leveraged, debt of that much. But you can see the high performers are doing quite well. They're earning, the business is earning 13% almost. They're personally earning about 15% or 13% or 8% for the middle group. These lower end have lower end of return on assets. And surprisingly, there's a group in there that has low return on assets but got good interest rates. And so they're getting a good return on equity. Profit margins go down as you get less and less return on assets, and your current ratio, you get tighter in cash, keeping less and less cash around. But their balance sheet gives them roughly that 35 to 45% debt to asset. So you can see there's a lot of variation out there. So the same point again here. This is 1 year in Illinois by different types of operations. Hogs had a great year, great returns on assets and equity. Beef had a really tight year and rough. Minnesota, again, you can see this 04, same year. This is across all their farms, but you're going to be a lot of grain and hogs in Minnesota. And you can see they got the top 20% are getting 13%, over 20% return on equity that year. So that's darn good. So you can see there's just a lot going on there. The one thing I like to point to this one is here's the net income from operations. So net farm income from operations and return on farm assets, net farm income as a, the rate of return on assets. You can see this is 2009 through 2015. This would be at the University of Illinois. This is net farm income from operations as a percent of, it's not as dollars, but as a percent of the assets, or I'm sorry, of the revenues. I think it's a profit margin essentially. You can see goes up and down across those years. It's gotten pretty bad here the last few years, and the return on assets is pretty low. By the end there, its average is pretty small, but they had some great years in like 2010 and 11. So what you really see is the cyclical nature of these returns. Here's the average is 23%. So net farm income from operations. This would, again, I think this is a profit margin is what I've been calling it. They're reporting it as a percent. What you see here is on average 23%, but you can see the ups and downs and the big long drop off the last several years up through here, 2015. These have been some rough years in farming. In the last, you can see they started falling back in 2011. This was the peak, and they've been coming down every year since, gone very low relative to the average. Okay, so that gives you a sense. And I think the point I'd like to really emphasize, there's a lot of variation in farms, even if in between farms and across years. There's a lot of variation from year to year, and there's a lot of variation when you compare different farmers to each other. But one thing to note is even when the markets are bad, some farmers make money, and even when markets are good, some farmers are losing money. And it's hard to stay in the always making money category, but some do. The last part here I'd like to talk about some of these farm accounting software. There's packages out there. This slide is from Jenny Vanderlyn. She works for the University of Wisconsin Center for Dairy Profitability. And this are some of the programs that she teaches classes in farm accounting. So the first one is AIMS, the Agricultural Accounting and Management Information System. Center for Dairy Profitability developed it and supports it. They actually run courses on how to use it. It's cheap and it's meant for dairy, $150. Ag Manager by Agri Solutions. It's a general farm accounting software. A lot of the farm credit systems or services are using it, like Compere, for example. Red Wing sells a software package called Centerpoint and Perception. It's more expensive, and often the ag accounting firms, if you hire an accounting firm to do your ag books, they're probably using this one. It's a very common one. Centerpoint is newer, and it's more for the farmers to use. So if you get to a certain level of sophistication, and you want to still do your accounting yourself, maybe you have enough expertise, that's Centerpoint. My understanding is Perception tends to be the one the accounting firms use. And there's other ones out there. Farm Funds, Farms Funds, Peachtree, QuickBooks, Quicken, MoneyWorks are all out there. And they're actually the Center for Dairy Profitability and UW Extension do a lot of programs and workshops for farmers to learn more about farm accounting because it's such an important part. Heart of the Farm, Annie's Project, and there's other ones they do as special requests. And other organizations do these as well. Farm accounting isn't important, and to be frank, a lot of farmers don't really enjoy doing farm accounting, but it's an important part of their business, and they know it. There are farm management associations out there, the Fox Valley and Lakeshore Farm Management. They have different amounts of members. What these are private associations, and they specialize in dairy because we are the dairy state. They provide various services for their members, tax preparation and some management planning advice, computerized and hand record keeping systems. They provide data systems for you. You can essentially, if you want these organizations or something like a farm credit system, or your bank or your farm accountant, whoever you hire, you could literally just shove a bunch of stuff in an envelope and mail it to them once a month. Every 3 months, you could stick it in a box and bring it in once a year. However you want to do it, they can do it that rough, where they go through everything, organize it, and structure it. Or you can just submit them a file once a month of here's what we spent money on this month, and they have all your money that you spent and all the money that came in, and they can see your software package. They have access to it. They do schedule on-farm consultations as well. These types of organizations will. Where part of what you're buying is somebody, okay, got my books, you know my information, and I'm thinking, the neighbor over here is retiring or is ending farming, and there's a chance to buy, 300 acres. I'd like to try to buy that. Can I do it? How do I do it? Can I do it? Can I afford it? How much can I afford to pay? And so you sit down with this person, they help you work it through. Or it's something simple. Can I expand my barn? My son and daughter-in-law want to come back and want to farm with us. How do we make this work? How much larger does the business have to get so we can support 2 families? How do we fund that? How do we make that happen? They would do the farm financial side of that with you. And then they also give you yearly farm business summaries and analysis, so to compare you to peers. And you can see, that's kind of like those AGFA data I've seen. And there's associations like this. Illinois and Kansas have some pretty good ones as well. And so in the other group, a lot of the ag lenders provide services like this, and they're within their group, like the Farm Credit Systems or various community banks and other, BMO Harris, things like that. So where to get more information, I think in the state here, Center for Dairy Profitability is probably a good place to get the most the best stuff there. Farm Doc at the University of Illinois, Farm Decision Outreach Central, DOC. In Minnesota, it's the Center for Farm Financial Management. We've talked about them already. They have some good stuff. They also, because they're so close to that part of Wisconsin, they actually do work in the Wisconsin up there. Ag Decision Makers, Iowa State University's version of it. It also has very good materials. Of course, you got the Farm Financial Standards Council. And then also note, University of Wisconsin CDP has been talking about releasing this farm bench to replace AGFA. And that's it should be coming out soon. So we kind of went through everything. How to prepare and read an accounting income statement, particularly focused on ag operations, how to think about cash and non-cash costs, and revenues and costs, and how to do accrual adjustments to your income statement. Then we talked about how to calculate these various measures: net farm income from operations, rates of return, and the profit margin. Then we looked at the data for the various income and rates of return in agriculture, and then look at some of the software